When a market is under acute stress, the entire narrative gets captured by one thing: the selling. After a political shock hits the system, everyone's focus, the media, the participants, is on the capital that's running for the exits. But of course, that's only half the picture. A market is always a two-sided ledger. For every seller, there has to be a buyer. And when the selling is loud and it's chaotic, the buyers are almost always silent. You won't see them on TV. They don't issue press releases. But you can detect their presence in the data, in the subtle behavior of an asset that's under duress. This is precisely what we saw in the silver market. Beneath the surface of that sharp, politically driven sell-off, something unusual was happening. The asset was being absorbed. And so the real question isn't why silver fell. It's who was providing the floor.
Who was on the other side of that trade? Who was providing the liquidity when the dominant emotion was pure panic? This is the central question of our analysis today, because the identity of this buyer, well, it reveals far more than just a contrarian bet. It tells us something about the underlying structure of the market, the long-term positioning of very sophisticated capital, and a potential shift in who actually owns the asset. Understanding who buys during a crisis is really fundamental to understanding where the real conviction resides. So to answer this, we're going to proceed with a methodical investigation. First, we'll examine the market anomaly itself, what the price action was telling us. Second, we'll go through a process of elimination, ruling out the typical players. Third, once we've narrowed the field, we'll construct a profile of the likely buyer. Fourth, we'll look at why silver, specifically, was the strategic target here. And finally, we'll discuss the macro implication of all this, a fundamental transfer of risk within the market. Okay, let's begin with the event itself. The catalyst was a geopolitical shock, a sudden policy shift that sent tremors through the currency and commodity markets. Now, the initial reaction was predictable, a sharp, headline-driven sell-off in assets that were seen as vulnerable, and that included silver. That's the surface story. What requires a closer look, though, is what happened in the hours and days that followed. The market stabilized far more quickly than you'd expect, given the magnitude of the shock. Despite all the fear, silver just did not act like a collapsing asset with no support.
You know, in a typical panic, the market structure fractures in a predictable way. First, liquidity just evaporates. Spreads widen dramatically, making it costly and difficult to trade. Then that lack of liquidity accelerates the decline. Stop losses get triggered, leading to forced price-insensitive selling, a cascade. But that's not what the data showed us here. Instead, the decline was arrested. Trading volumes, which should have collapsed, stayed elevated, meaning large orders were being matched. And most importantly, the futures market remained stable. This tells you there wasn't a cascade of liquidations from leveraged players. The panic was being contained.
This kind of market behavior is completely inconsistent with a one-sided panic. It leads to a single logical conclusion: that immense selling pressure was being met by significant and maybe even larger buying pressure. An entity or a group of entities was systematically absorbing the volume being shed by panicked sellers. They were, in effect, providing the floor that prevented a full-scale collapse.
So our investigation now shifts to identifying this buyer, and the most effective way to do that is deductively. We're going to first eliminate the most common market participants to isolate who the anomalous actor really was. We will determine who it was not.
The first and most visible group to consider is the retail sector. Was this just a surge of buying from individual investors reacting to the sharp price drop?
The data doesn't support that at all. The main way retail participates in precious metals is through ETFs. And if you look at the flow data for the largest silver ETFs, there was no significant deviation from the baseline, no spike in inflows that would suggest a wave of retail buying. Participation was completely normal, so the buying originated somewhere else. Okay, so what about short-term speculative capital? This would be your systematic momentum funds, high-frequency traders. They thrive on volatility, so it's plausible they could have just reversed their positions to play a quick snapback rally. But again, the evidence points in a different direction. The Commitment of Traders report, which breaks down market participants, showed no aggressive flip from net short to net long among the speculative community. This wasn't the fast, leveraged capital that typically tries to trade short-term swings. The accumulation was more patient. A final conventional suspect would be the silver producers themselves. Mining companies often use futures to hedge their production. A big price drop could, in theory, be an opportunity for them to buy back those hedges at a profit, which would look like buying pressure. However, an examination of producer hedging programs doesn't indicate this kind of activity on a scale large enough to stabilize the entire market. There might have been some minor opportunistic buying, but it just doesn't account for the sheer volume that was absorbed. The primary buying pressure was coming from another source entirely.
So we've now ruled out the most visible and predictable participants: retail investors, short-term specs, producers. This is the loud money that typically dominates the short-term narrative. They weren't the primary actors. So by a process of elimination, that leaves only one category left: the quiet money. The entities that operate with strategic patience, a long-time horizon, and often without any need for public disclosure. Now that we've established who was not buying, let's construct a profile of the entity that was. There are generally three categories of market participants who fit this description: those with the capital, the mandate, and the temperament to absorb weakness during periods of politically driven stress.
First, large-scale industrial consumers. For corporations in electronics or solar, silver is a critical input. A sharp, non-fundamental price dip is a huge strategic opportunity to secure physical supply and lower their long-term cost base. Second, sovereign or quasi-sovereign entities. Think central banks and state-backed investment funds. Their mandate isn't quarterly profit, it's the long-term accumulation of strategic reserves. They don't chase rallies, they absorb weakness. And third, you have long-cycle private investment funds. This could be large family offices or institutional asset managers. Their capital is patient, and they make strategic multi-decade allocations into assets they believe are undervalued. For them, a panic is the ideal entry point.
The unifying characteristic of all three of these actors is their methodology. They operate on a different timeline with a different set of inputs. They don't need positive price momentum or good sentiment to act. On the contrary, they're valuation-driven. A politically induced sell-off creates the ideal condition for them. It's a price dislocation based on a temporary narrative, totally unrelated to the asset's long-term supply and demand. They see that as a signal, not noise. So, this brings us to the next logical question: why silver? Of all the assets that were affected by that geopolitical shock, why was this specific metal the target for such quiet, determined accumulation? The answer lies in silver's unique dual nature and its position within the broader commodity complex. Gold is the world's primary monetary metal. It's constantly under a microscope. Its market is deep, liquid, and followed by every major financial institution. Any large-scale accumulation in gold is quickly detected. Silver, by contrast, is a much smaller, less liquid market. Analyst coverage is thinner. It operates, relatively speaking, outside the main focus of institutional capital. And that opacity makes it the ideal vehicle for a large entity to build a significant position without moving the price against itself, to accumulate quietly. Furthermore, silver sits at a really unique strategic intersection. It has exposure to three distinct drivers. First, it is a monetary metal, so it's sensitive to currency debasement and financial stress. Second, it's a critical industrial metal, with demand tied directly to high-growth sectors like solar, 5G, and electric vehicles. And third, its supply chain is geopolitically complex. So for a sophisticated long-term actor, an asset with simultaneous exposure to monetary, technological, and geopolitical factors is exceptionally strategic. It's like a diversified hedge in a single instrument. And this brings us to the final and most important implication of this activity. The presence of a silent, strategic buyer during a panic sell-off is not just a curious anomaly. It signals a fundamental change in the composition of the market. It represents a transfer of risk. On one side of this transaction, you have the sellers. These are the weak hands, participants with a short time horizon, leveraged speculators, momentum funds, and retail investors driven by sentiment. They are forced to exit their positions, not because of fundamentals, but due to fear, margin calls, or just a reaction to the negative headlines. And on the other side of the transaction are the buyers. These are the strong hands, the patient, well-capitalized, long-term strategic entities we profiled earlier. Their balance sheets can withstand volatility. Their mandate allows them to look right past the immediate noise. They absorb the positions being liquidated by the short-term holders, effectively transferring ownership of the asset into a much more stable long-term base. This process is known as a transfer of risk. It's a crucial, if subtle, market signal. It indicates that the downside risk is being contained and absorbed by strategic capital, rather than being allowed to cascade through the system and create contagion. Now, this action does not guarantee an immediate price rally. That's not its purpose. What it does, however, is fundamentally alter the market structure going forward. The asset is now held predominantly by participants with a higher pain threshold. This makes the market foundationally more resilient to future shocks. The risk equation itself has been changed. If silver were a fundamentally impaired asset, it would not find such a determined, silent buyer during a period of maximum stress. The panic would have simply cascaded.
Instead, an entity with patience, deep capital, and a clear strategic framework stepped in to absorb the selling. When the public narrative for silver eventually changes, and it won't be announced in advance. The media will follow the price. But history shows that in these markets, the strategic positioning is established long before the story becomes obvious. The buying always comes before the story.